As you might know, I'm Michael Son, I'm partner with Grossman St. Moore. We are external auditors. Next to me is Chris Alger, who's actually a supervisor in the account. So we have other staff on the account that works at the account. We've been auditors for a number of years now. If you have any questions as we go forward, just let me know. We have a simple presentation here that's done historically in front of the board and audit committee. We walk through all our required communications as required by our audit standards to discuss this with the board or committees such as the audit committee. And so if there's any questions on anything, especially technical terms, sometimes stuff is CPA jargon, as the committee members know, and I'm happy to try to translate it more.
Okay, break it down.
Sure.
I'll just have a quick procedural question.
Sure.
Usually it's three of us.
That was actually something
Just how are we have other board members here. They have the right to discuss.
I was actually just going to comment on that after we're finished. So because this is a public session, other board members and obviously members of the public can attend, we can discuss fully amongst the board members over here. The board is nice to ask any questions. We cannot make any board decisions, motions, those type of things.
Discussion.
In this meeting, discussion can take place, and we have to keep our discussion to the audit committee business. But other than that, other members are welcome.
If they can participate, they can ask for questions. I thought of them, but I just wanted to make sure. We didn't go over the line.
Hopefully you guys, I think the audit committee has seen these, the draft financial statements, everything in advance.
Jim said it will
Forward, yes. So, we want to review this last week.
That's right.
So, we have a simple presentation on the left side of your folder here that's in color. And we'll do is walk through that as we have some questions. We'll walk through the basic financial statements and some requirements. In the presentation, we have a very simple agenda. We walk through our communications with you. This is the first slide. And we walk through your basic financial statements, comments, things called management letter comments. We walk through your ECA reports, which we did discuss with the audit committee at the last meeting, so I'll kind of cover that at a pretty high level. And then we talked about the single audit reports, which we discussed at a pretty high level, but the report was more or less talked about some of the findings. James is going to fill in a little bit, but we'll walk through that. As you're aware, those charged with governance, the board and audit committee have a lot of responsibilities that are charged to you. One of those, is you're responsible for these financial statements. Management owns the financial statements, ultimately, they report to the board, and ultimately the board, takes ownership of those. So we just like to remind you that they're not our financial statements, they're management's. And you'll see that even in our new audit opinion this year, really due to the clarified auditing standards, actually breaks it down more specific. Like anything, I joke with people, when we clarify stuff in the auditing world, it got longer. Your audit opinion used to be about a page, now it's almost 3 pages. But it really kind of clarifies, here's management responsibilities, auditor responsibilities, and it goes through a little bit more detail to help it understand more. So our responsibility, as I said, is to give an opinion on your financial statements based on our procedures we did. That's what we're going to do here. Something new this year that the board is probably not fully aware of, we talked about the audit committee, is there's actually this new thing called compliance with all ethics requirements regarding independence. What this is under auditing standards for governmental entities, there was some changes this past year that says we have to look at certain procedures that we do to help management out. A good example is, you probably don't think about this as a procedure we do that's not audit, is the preparation of your financial statements. That's not our responsibility to prepare that. Actually, it's management. So what happened is, most governmental agencies use your auditor to help prepare it, but it's from the information the management provided. So that's how we build some safeguards is if management's information, when they say they take ownership for it, or if they have a chart of accounts developed by them, we would not be technically independent of management, meaning we couldn't do your audit. I hate to say in the future, given the way the standards are moving, sort of like public companies, I wouldn't be surprised in the future that if management doesn't prepare their financial statements, your auditor can't prepare your financial statements at all. But they haven't gone that route yet, but they're kind of in they're moving towards the directions of the public companies where, you know, you assume something. So, public companies, private stock, that, you know, your auditor shouldn't be preparing your financial statements.
Auditor should be the watchdog.
And I hate to say, your financial statements aren't short and sweet. As you know, they're over 50 pages, a lot of information disclosed, and they've gotten a lot more complex in the last, not just the last year or two, it's, you know, in the last 5 years, there's been probably about 12 or 15 new accounting standards that came out, new compliance things that your state pushes out, so they're getting more and more complex for management to deal with. So a lot of people ask me, you know, what does this mean in the future? I said, not sure exactly yet, but most of our standards move at a pretty slow pace. But you know, ultimately, it could be something where you're going to have to outsource the preparation of financial statements unless you keep it in-house. You know, majority of our school districts don't prepare their own financial statements, so it's not going to be common. Very common, but it's something we need to discuss with them. It's new this year.
Current districts do their own book paper, shows or experience or training the person have to have a handle on how to do that.
Well, like I say, you need to have a CPA. You know, we have people who are not CPAs do it. They need to have definitely a bigger background in accounting, understand the accounting regulations, the school district finances. These financial statements, I said, are going to be very long. A CPA should be easy to do this, and that's not necessarily the case in most school districts. You know, you don't have CPAs on duty.
Another thing is also you're tied to one person.
Yeah.
Again, you're tied to a firm. Sometimes
Yeah.
you have the backing of a firm to be able to do it.
A bigger firm to do it.
And I think that you know, that's a safe.
My sense of what you'll probably see is, you know, if this comes to fruition, which I think will happen in 5 to 10 years, just the way everything goes in the world, more and more, is if you can't do it in-house, you'll outsource it to, you know, somebody. Could be BOCES, and maybe they get somebody in-house that's really expert at this. Because I hate to say, school districts build a template, you know, other than information, the numbers change. It's very consistent in the presentation of school districts. You know, some schools disclose more than they're required to do, some, you know, just the minimal, but most school districts will probably go that route. You know, the BOCES can support it. BOCES does a good job supporting a lot of different other functions. We're slowly trying to build a business office that has more to keep. That's a unique insight that's changing, and let's see what that takes us. The next bullet point is just talking about the qualitative aspects of the significant accounting practices. Technically this year, not a lot of accounting policies have changed from the standpoint, you know, most accounting policies that the district adopt are adopted from the board down at a pretty high level. And then what happens is you have to adopt stuff that's related to new accounting standards. There really wasn't a lot of new accounting standards this year that really impacted the school district adoption. There's a few new ones coming up in the next couple of years, pension accounting, and will help, you know, the district look at that and make sure they're compliant with that. Next one coming here. Significant accounting estimates. One thing unique about school districts is there's not a ton of estimates in certain numbers. There's certain kind of rules and governmental accounting standards that kind of limit certain things, especially on your fund financial statements, which are, I would hate, you know, to tell you, generally cash basis, a big checkbook throughout the year. At the end of the year, you convert stuff to accrual base. Everybody understands accrual. So when you convert to accrual base, you know, that gets your ultimate financial statements here. But in accrual-based accounting, there usually is more estimates. And your estimates in there for the school district that are significant are your depreciation, useful lives of buildings. If you recall your GASB 45 actuarial analysis, this is post-employment benefits. This is the dollars that you ultimately pay out to retirees for healthcare costs for future. And you did have an actuarial evaluation just recently done. And this is one reason why we moved the audit committee meeting out. It was just received a week before Friday from the actuaries. We just wanted to make sure that was including your numbers. That's probably the most significant estimate, because they make assumptions on actuarial analysis, projections out, they make assumptions on discount rates, interest rates, and things such of that nature. And that's the most significant.
When new standards come out, how does that affect like the school district as far as, is that information get down to people that need to
try to be proactive. You know, most of our school districts are pretty simple and they're not paying attention to the standards. Yeah, you're not.
I mean, so what Mike has done in the past, the audit committee meetings, is he's let us know kind of what's coming down the road. So we are getting some insight into the administrations here that are here as well. So he's let us know.
Yeah, we do a planning meeting with the audit committee that walks through all the new accounting pronouncements and some of the new stuff that was coming up. A good example is pension accounting. This is actually going to be a significant impact on the school district, not from your funds, but from an ultimate liability. What this is there's two new GASBs out there, 67 and 68. The 67 is the accounting for the pension plan itself, New York State, TRS, teacher. That's where your pension is. And there's new accounting on the pension plan, and 68 is actually the application of the accounting down at your level district. That actually would be applicable for you on June 30th, 2015. What that's going to do is just like the for-profit entities, is sort of like the GASB 45 that did with your liability for healthcare. This is going to say what's the pension liability from teachers and ERS students, employees too, working at the district that in the future the district's going to have to pay. Right now that liability is not your books. As we know, it's a pay as you go, and you just report the current liability which is due next year. So, and that probably be a pretty sizable number.
It's going to flop the books, but
Yeah.
at least it's better to know.
Yeah.
Maybe down the road, they're going to allow us to put them away. That's
one of the issues too. You're not allowed by law to put money away on the side, including the GASB 45. And that was some of the discussion, I'm not sure if management had this with you, we call it the JEBOE reserve. At one time, the comptroller said, oh, put away money, and they kind of go back their answers like, yeah, it doesn't really meet the rules of your state. And this is why they're allowing you to actually pull the money out without problems. With approval by the comptroller. They kind of made you put it in there, and you guys put in quite a bit number, about 900,000 or so, and you actually used a little bit this year. That was kind of a mistake the comptroller made and give guidance on a reserve. As Paul said, there's no allowable way to put away a reserve for this right now. This is the GASB 45, even though it's a sizable liability, and the state doesn't allow you to sock away money for that yet. There's been some discussions over the last 3 or 4 years, but it's a legal thing, not accounting. Some places would probably love to set up a trust and start putting away money and then kind of like a annuity and say, okay, we really got to pay $5 million out in some future, and start to help alleviate that cash flow and look out in the future and put away something. The state does not allow that at this point. So it's unique.
Think they will allow that?
Well, once you get the liability for the pension on your books, maybe the politicians will actually realize there's sizable liabilities in these school districts and municipalities too. It's not just schools, it's all governmental agencies are going to have to do away with these liabilities. And if you can manage it, possibly get, use a life insurance company like annuity, say pay $500,000 for $1 million coverage and they cover $1 million. That's a great way to kind of help alleviate that pressures.
Is it just a fear of mismanagement of money? Or that they'd rather have you have to wait and pay on a cash basis versus...
Most governmental stuff is cash basis. Here now, these entity-wide financial statements are really accrual based and kind of get more closer to like a not-for-profit corporation or for-profit. So as these things start creeping up and start showing up like financial statements, bigger liabilities, it kind of makes people consider, well, wow, we have a lot more liabilities than we know. Because previously it was just cash basis. It was due next year, how many books and records. It was due over the next 20 years. Who cares? So times are changing slowly, but we'll have to see exactly where they're going with this. So that's the big hitting things that are happening. That's a big one, but it's hard to know. At one time, the New York State's pension was about 96% funded. Numbers about a year ago, but also New York State used what we call a pretty aggressive actuarial method to calculate their liability. New York State was in their favor. When I say first conservative, what actually is interesting enough, the GASB, first time I've ever seen a standard sentence is they only allow one method of actuarial analysis used for these things, and it's actually more conservative, meaning New York State seriously by 0.98%. short, about $1 billion something short on paper. New York State is actually way better off than a lot of other states. You know, like your sort of Illinois, for example, their pension system is like 50%. California is not. So New York is actually in better shape. And that ultimate liability, the difference there, theoretically, some portion of that's going to be on your books and records. Ultimately, Steve is working at JEBOE, that's actually, that expense is driven from the work here, hopefully it's paid for the plan.
No.
Yeah, they quickly canceled that idea. Yeah.
There's a lot of stuff going on in the town world, and I joke a little bit that the standards for governmental tend to move really slow. Lately, they've been moving along with new stuff, new changes, and they're really kind of mirroring a little bit of what the for-profit just did. Think about what happened with GM. Once the FASB's, the for-profit entities, they came up with the same type of pension, items for county about 10 years ago. Mysteriously, GM went, holy cow, huge liability. Mysteriously, down to county, everything else. And that was their biggest owner, their shares are actually their trust that owns this stuff. It's something that they've bought into it because they owe so much money. They would never hold it to people's hands. So it'll be kind of a wake-up call. But, you're not going to be in different shoes than other school shoes. So you're a little bit handcuffed with legislation and how New York State will allow you to fund it too. So, as you know, right now, you can't even put a reserve on your accounts for TRS things. It's teachers. You can do ERS, which is schools put a little bit aside. For some reason, school districts are now allowed to set aside money in their reserve for teacher retirement system. Don't ask me why, it doesn't make any sense to me, but maybe they'll be smart about it and say, maybe we'll enact the law clause to do that. But it's probably might be a little bit too little, too late, because school districts are now some property tax and everything else going on. You don't have a lot of able to put a lot of reserves in. You don't have that wiggle room to set aside reserves. So we'll have to see. Next item is just significant difficulties during the audit. This is when we really had nothing there. Management was very cooperative with all the work we did. No issues there. We had to get through the items, making adjustments, discussing the items. It's really more cooperation. Findings, yeah. Cooperation and access to management. It's sometimes significant difficulties is usually if there's nobody here, sometimes it's a difficulty in forming the audit. We formulate. There's nobody here. Management was here, very cooperative, working through it with us. Everybody was open and accessible. So it usually rarely becomes an issue unless there's nobody here. And it becomes like, just got to let you know.
That's never going to find out that.
I hate to say, if you know somebody's not here working, like say the treasurer wasn't here, that becomes a difficulty encounter. Now we're kind of solo. You might not have the expertise we get versus this. Yeah, where it may be more adjustments because there was nobody here. The next page talks about some of our uncorrected and corrected statements. Most schools, post every single adjustment we propose. Not necessary, as I said, your financials, not necessary that you post everything, but that could change our opinion on the financial statements. Management did post all the entries. And as we look into your handouts, in letter A there's actually a summary at the back of that shows all the adjustments, kind of summarized on a high level what that is. Not sure if you want to look at those real quick. And actually, for some reason, it was attached in B in the front too, but just it's just a little summary for the back of the letter. That letter itself there is actually basically the same as the presentation. It's just a formal letter that we put our letterhead on versus the presentation. Both meet basically the same requirements. This page here just shows. Okay. There's a page that shows all the summaries of what's going on, all the adjustments being posted, and management took responsibility for these. Just goes through each fund, gives you a sense, dollar amounts. We try to put the material ones on here. Give you an example, there was close to probably 25 entries posted in the general fund. Some are in and out that, we find out answers later on, they're reposted, unposted. So we summarize it here at a higher level, of the significant adjustments that we had to record as a result of our audit.
So, in basic lingo to me, this is but there would be a level below this that could be asked for. Define, how did you come up with the 6 million?
Yeah. We find this.
This is the easy way to
We have
bring it.
debits and credits,
Absolutely.
account numbers attached to them, and.
I think we talked about the Zoom report in my
So
opinion.
it gives you a sense, and, more than happy to explain and give you more.
If we
detail.
saw something we wanted to drill down, and it would be an easy type of thing to say, where were those?
And we break it down by each fund. Because as you recall, if each opinion, we have an opinion, each fund has its own materiality. Meaning, the school lunch fund isn't as big as the general fund, but smaller items could be very material to it. When I wrote down my materiality, just to give you a high level sense, this is like overall that, kind of a judgment we made. So like for the general fund, we used about 414,000. For school lunch, 10,000. Capital projects, 59,000, and, especially 21,000, debt service, 27. And that's an auditor's judgment. From a management standpoint, I would expect them to be lower than this. Because this, remember, we're auditing a material that's, free from material statement. We're not looking for every nut and bolt, but this is kind of a starting point. It gives you a sense that it's not, just because the general fund is really big, every other fund is small, therefore you're never going to find it. And that's why we like to break this down and give you a sense. So sometimes a little problem, good examples of the trust and agency fund, doesn't have a lot of activity. So if you miss something, it becomes very material very quick. Any questions so far in the overall summary? Disagreements with management, this is done. When disagreements come from management, it means basically we disagree with something we said. Sometimes we excuse management, we excuse it for really difficult situations. Disagreements usually very rarely come from management unless, it's adversarial or something. And these communications we're doing here, folks, is done for everyone. This is standard, even my public companies, big board, million-dollar corporations, it's the same things. It's required, this is not unique to our firm, or every CPA firm does this. Now, how they translate it to the little details is a little different, but the very basic goals you see here are similar. So
Again,
and even the terminology is the same too, that's why I try to.
my bad. What is this?
Propose an entry, and they basically say, we totally disagree with you. We don't see your point of view. Okay, that's fine. We live with your number. Then, he as an auditor has to assess how material that is to the financials. And does it impact my audit opinion? So you have a disagreement. And as a board or audit committee, what we're trying to tell you is that, hey, we have disagreement, and that's okay. But, here's what it was. And you probably ask me, okay, how is the conclusion of it? Is this material? Meaning if it was material enough that I can sign your audit report, clean opinion, I might modify your audit report, we'll talk about that a little bit. Versus, now, these are called qualification, by standards, we change terms, it's called unmodified now, it's a clean audit. We would modify our audit opinion. Now, if it came real bad, I've only done this once in my life, we actually did adverse opinion. Adverse opinion usually means I should have just walked away from the job in the first place versus issuing it. Meaning either the information or other information was so awful that we couldn't even give you an opinion. Meaning it was, we got to a certain, in most places, you never get there, because either as an auditor, you just resign and say, we don't want to deal with this, or it gets push comes to shove, where somebody says, I just need an opinion on this today, I'm like, well, I'm done, I can't do anything else. Very rarely get that, that's the worst type of opinions. 4 opinions, unmodified, modified, and another thing called disclaimer. The disclaimer is, it's bad, but not as bad, in the sense that you disclaim for a certain portion of the audit. Maybe somebody else did the work for you, and say, well, we didn't, the big piece, but somebody else did the audit report, therefore we disclaim our opinion on that, but refer to somebody else's opinion. usually see this in big public companies where they have multiple entities or maybe a foreign entity audited by another location. Very rarely we see it here at school. Usually modified, unmodified, very rare. Most schools are very cooperative and say, we just want to get it done right, help us through it.
One of these things, something that we also want to say is, that should probably come up in the presentation.
Yeah. Yeah,
What was something I wanted?
Yeah, if there was something you're talking about right now with this graves management, or if the committee has some issue that we want to talk about without management, you know, that's free game. It should be
It was
done.
on and freshman. I chose the second one.
Okay. Yep.
Presentation. And I picked up on it.
Okay, that's fine. So I'll flip them and cover that both. The next item, representation from management, request from management. This is a management representation. This is the next bullet point. What this is, you know, under our audit standards, we're required to have representation made from management. Basically what it tells us is they've given us all the records, the books and records, complete and accurate, that they're unaware of anything that, you know, they haven't already told us. This is more about a completeness thing that we need to give our audit standards. It's a pretty standard letter. When I say standard, it's, you know, it's a template that's used and a little bit tailored for each unique situation. There's very standard stuff in there. And historically, we share that with the board at the meeting, or at least put it in there. I can send you a draft of what it looks like, but usually you sign it on, manually sign it on the date of 40 seconds. A quick example here is if the manager didn't sign it, couldn't be a representation. It happens once in a while, and you have changeover and people leave. And June 30th is when we're there. CFO leaves, CEO leaves. I'm sitting there as an auditor, I gotta have this letter. So we would then take an assessment of what that means in our audit opinion. Generally speaking, we can't get comfortable with a certain representation needs to be made by manager. We would have to modify our audit opinion for that, which is kind of awful sometimes because it's really rule-based. But, you know, depending on the nature of representation needed from somebody, that would impair the opinion itself. Management consultation with other accountants. What this is trying to inform the board and the committee is, you know, as management said, I don't like what Mike's talking about. I'm going to talk to some other accountant. Get a different opinion. I don't care if you do that, but could be a good opinion, bad opinion, you have something, but we need to formulate that. So what that means is maybe they want opinion shop. Sometimes what happens is, you know, manager doesn't like our answer, you know, they fire us. And they go hire the other firm without the board really knowing. So that's a way to actually, or maybe the board knew about, said, oh, they're just not good for them, okay? We're gonna go with them. But we have to inform you of that, you know, that they might have went out there looking for a different opinion on something that we disagree with. Very rarely does it happen, but it could. Other significant matters, financial issues, this is just kind of a catch-all. Really nothing else for discussion pertaining to retention. What this is, if there's any issues from our retention and performing work for those network teams or like that we would disclose in front of the committee.
On that moment, the management consultation with other accounts, I know we didn't have that. Let's say, we didn't like you, fired you, fired Chris. We like his opinion, Jim wants his opinion, right? And they give it to the audit. Do they have a responsibility to say that there was other accountants? You know, that
Depending on the amount of level of work, I mean, this is based on, we're gonna give the audit opinion, if we, you know, if we terminate it, you know, another accounting firm, first of all, required to talk to us, you know, I can ask if there's any issues that we know about that, you know, taking the first of all, we're required to talk to them that way. You know, historically, we talk to them, we got communicated to you guys, it's really not up to us to decide who you pick and choose, but we just gotta be out there and say, hey, they pick another, opinion shop a little bit, kind of answer they like, well, it's up to you guys, it's not me
So
that.
with him doing the audit, he also say, you have to say there was other,
He would communicate that we've reviewed, yeah,
that would be all.
it's a dual, yeah, it can be both sides. It's an audit. That's the basic requirements that we walk through on all the audits. Any kind of overall questions there on that?
Maybe if event that we are forced, not forced, we make the decision to have another firm, that could be a place that it could be a little bit of that.
Yeah, you usually don't change firms in the middle of the course. This is usually, you appoint somebody and then they're off and
No,
running.
what I'm saying is you have the accounting firm for the retirement end of it, you've got, then you ask a question, now there's a disagreement, and that would have to be brought.
Brought to light.
The auditor is still the primary one that has to certify.
Takes responsibility,
it.
but
You know,
we
maybe
bring to light
that's
and
where
talk to someone.
that's where you
It's
get a
really for
little.
information for you to decide, ooh, we need to do something different.
And when this is finalized, it's filed with the state,
Yeah.
and that would be filed.
Yeah.
If someone says they're doing the job,
Yeah,
so,
Ooh.
worth a shot.
with a shot. Most places don't like to shop, they're in the middle. You're trying to take an independent opinion. The second you say, I don't like your opinion, that's why we're requiring it defeats the purpose, so it kind of goes against, that's why it's so critical we discuss this. The next couple slides is actually the financial statements at a high level, so we won't go through in detail, but there's questions for your review, let me know. Specific, but as I discussed, some I've already discussed, so I'll try to go through this really quickly, but I'll stop. Your audit report this year will be an unmodified report. That's actually your cleanest audit report you can have. If you recall in past years, we call it unqualified. So historically, you've had unqualified financial, meaning there's no qualifications. Even though the terminology sounds quirky, it's actually a clean audit. Ultimately, the financial statements are free from material misstatement, meaning they're presented fairly in accordance with accounting standards in New York State. When I say New York State, New York State gives some guidance, but it's really the Governmental Accounting Standards Board is the crux. New York State has some guidance, but it's actually the lowest level authoritative guidance. Sometimes New York says, we like you to do this, but 90% of the time, we also have a little reference in the notes saying, ask your auditor for their guidance on it. So it's almost odd, they give guidance at a high level. So that's what we say is unmodified financial statement.
Unqualified.
It's not the same as unmodified.
Previous term.
Yeah, we always like to keep people on their toes and change their stuff, so.
Yeah.
And how do you apply, what's the threshold?
Well, there's a ton of things we do as an audit. We start with planning, determining we have inherent risk, control risk. Inherent risk in your district is a little higher due to the task issue procedure. Okay? Inherent risk goes higher because of program management. Inherent risk goes higher because of change in systems. You've got a lot of indicators say, as an audit, automatically your risk of inherent risk for our purposes is higher. Then we walk through what we call control risk. We look at individual controls and say, okay, what's the risk of your controls aren't designed or working effectively to prevent and detect misstatements. So we go through that assessment. Then once we come through all that assessment, we determine how much substantive audit procedures we do. Historically, for school districts, we go to more of what we call a substantive audit approach. What that means, we pull a lot of transactions, sample transactions, materiality, we pull transactions for support, for accordance with company policy, board policies if they're there, and test that to make sure what we call audit assertions, there's completeness, there's accuracy, the transaction valid, even presentation disclosure. Remember, these financials are yours, so the disclosures that you put in there, we actually, certain things we gotta look at and say, are you presenting enough information for disclosure purposes? And we do a ton of procedures that go through that to test that, to give that opinion. And it's not just one big procedure, it's all different across the board. But certain things are required by our standards. Performance, certain places have a lot of inventory. It's required for us to do and observe a physical inventory. Unless it's either material or, so certain things that, but most auditor stuff becomes auditor judgment based on that risk assessment. And we go through painstakingly, what we call the financial statement assertion level, deeming what we feel is higher risk there based on past performance somewhat, current performance, discussion management, also what's going on in the industry. We kind of build up that together and then build up our audit plan. And we actually discuss that with the audit committee at a high level and you go out and need some, direct, yeah, you tell me, Mike, hey, I want you to do a little more work here. Sure. And, that's up to you. I have my risk assessment, I shared that, audit committee, and, back in, I think, May timeframe, so that's something we can do. But we go through that with the audit committee, in detail, what we feel like the risks are. Sometimes we excuse management, depending on if we get to the materiality, we want them to understand the level we're auditing to. Because that's the purpose, I remember that conversation, we purposely didn't say it in front of Chairman Paul, and you saw it. And that's what we discussed, what our planned audit approach is.
We also do that with respect to what's an external versus internal.
Yeah, I think we had that conversation with an external versus internal versus claims audit versus evil IRS audit. People think as an auditor, you're an IRS agent showing up, and IRS agents just try to collect money, they never seem to find you a refund, right? So, it's true. I hate to say it, they don't look for that. That's not our purpose and intent of this audit. Our audit is to give an opinion on your financial statements. And it's pretty much the area of focus. Internal audits are usually more compliance driven, more specific policy procedures. Claims audit, as you know, is signing off your claims. IRS is trying to get money off you. So there's different comptroller's audits usually are more compliance oriented too. Comptroller comes out, they assume you have a third party doing your audit of financials. They don't care about the financial stuff. They tend to be more rules and regs related. That's why we do the comptroller report. They tend to be more, this rule you weren't really applying. Well, that's their focus on their reviews.
Yeah, where are we on,
It's not off that line.
Discussion and analysis.
Yeah, new opinion.
Thank you.
So the new opinion on the format, this is where I explained earlier, it's pretty long-winded now, and they actually have sections on, reports of financial statements. They actually have sections of management responsibilities, auditing responsibilities, the opinions themselves, other matters, and they break that down. From a standpoint of big picture, not a lot of change, but, for the CPA profession, people would understand it. It was kind of a earth-shattering change in certain things. But it's supposed to help you. The average user understand what it means. I think it's confusing a little bit more, and add more information.
I'm probably confused, so I'm going to ask a question. Okay, we're in the report of financial statements and the management's responsibility for financial statements. Budget status report. Is that part of the financial statements? No. That comes out. Okay. Nowhere in this new report. Okay, yeah, I do see in budget monitoring, there's reference to it.
Yeah, there's a highlight, there's a financial statement schedule at the very back of your financial statements, required by part of RSI. It's a budget actual, status. It's actually expenditure based, it's required by GASB. That's at that totality level, high level that is required for the standard. The budget status report, if I recall, should be at a more granular, at a more ST3 level, which New York State requires that to be reported to management to the board to understand where we're at with everything. I think we talked about it.
Oh, absolutely. And that's what I wanted to, because in one of your drafts, it says that the budget status reports were prepared by the district as required, distributed to the Board of Education review. There's no evidence that it's done like this. Okay.
Yeah.
I was the one harping before I was a board member to get one. Didn't happen. As a board member, I was harping. We got one. Okay. And now,
I'm saying you should be getting them every month.
So that
The
is-
system is designed.
that's what we're trying for.
It comes out.
Well, and just piggyback on that, because when I went through it, I picked up on that. And I go back further to see that in April 11, 2011, these gentlemen in the public said, here's the requirement, and that's what I said. You have to have no treasury cash reports. We were hit with 6. And Paul read to the current board, here's a mandatory report, required quarterly, monthly if they're ready.
Yeah, changes, yeah.
And I repeatedly, I have written documentation where I forwarded it to the board to almost the extent that they've gone to. report, I don't know how we can do our monthly due diligence and annual due diligence. We don't have the actuals, returns.
You should have, that should be given to, you know, you shouldn't have a lot of budget transfers, but as I recommended, is that you should be doing that on a monthly basis. There's nothing that should be in there that's unique. I mean, who's got to have explanations and stuff, be prepared to talk to the board about. It's not a big deal.
And I'll wait till we get to the point where, you know, it's my opinion that it has to be reflected. Does it impact this year, last year? I just see that as at least a serious deficiency, if not, great, because I see that some of these other things that are written up as serious deficiencies stem from lack of.
I think this is why we have this conversation in advance. If you don't feel confident that the information is provided, you want to have to, you know, feel confident that we're verbally blind and the writing. Because I think that's a control that I don't see from, you know, I see the reports, they print them, and I'm assuming, I don't know when they give them to you, how detailed they are. So from my standpoint, I don't put a lot of reliance on that control. Remember, my testing is about internal controls. Knowing the weaknesses, especially with a new system, I really didn't leverage those controls, so I didn't really want to just test them, because it doesn't really provide any value to me.
So your step-by-step, without taking a lot of time, a little quick here, is saying that as the audit committee, we should be pushing that button towards administration. And if it's not, then go to the full board and say, we're not getting what we need.
I think this is, I'd be more than happy next year, maybe reach out to all the board members, and say, here's a laundry list of things I would expect you to see. What's your take on it? You've never seen it, you know, you might not have seen it. If you did see it, okay, I remember at least getting it kindly. And if that's an issue, you know, I'd be more than happy to put that as a comment and, you know, providing it. As I said, we don't get testing controls for effectiveness, and sometimes we just step over them because we have to be in the way. They were problematic because of adjustment. Usually budget status reports would result in auditor judgment or audit judgment, change in financials because of the budgetary for the auditor budget. Ultimately, we want to make sure you're within the totality of your budget. That's the ultimate responsibility. The manager's got a different responsibility to report to you changes on a month-to-month basis. That's not part of our.
Good. Good.
Okay, right now. So a good example of your plan is next year at the risk assessment, we say, Mike, take a look at these stuff, go back, look at it, see if it's complete and accurate. Tell me if you have information in, it's complete and accurate. Great.
That would be part of a risk assessment.
That would be, you telling me, that would be something I would say, no, the audit committee would tell me, say, hey guys, hey Mike, Chris, Christine, you know, I'm not very confident we get all this stuff as accurate because you guys take a look at it throughout the year and see if it really met the standard. You know, it's not a county standard, that's why we don't,
And
it's
that's
a year
usually,
state plan.
one of, you mentioned the fact that it was not at the level it needed to be.
Yeah, we
We
talked
got one more level down, and that's.
I agree with what we need to say.
Okay.
I think the detail is, should be all open, revenue, and it's a can report, your system. Your system is actually a can report to meet your state requirement. Push a button, and I'm assuming it reconciles, and we can close out from the fund. You always want to make sure everything's in there, so postings are in there. Can report. In the new system, the old system, I think, push a lot.
I mean,
We have nothing else on this slide, is there any further questions? Your basic financial statements is the next slide, we already talked about the modified financial statements, your opinion. As you know, there's an annual discussion analysis here, that is actually a portion of your financial statements that's unaudited. That's where actually management discusses what happened during the course of the year. Basically what this is kind of a regurgitation of things that have happened during the year. This is financial discussion analysis. Okay. So that is referred to as the MBA. This is actually at the beginning after your financials. I wrote down the page numbers, it seems short, but it's page 4 through 17. That's actually required for the standards, but it's actually an area that we technically don't audit, but because it's included with your financial statements, it's reviewed and make sure the numbers are at least consistent and there's nothing earth shattering that should be changed. Then we talk about basic financial statements. You know, when you see the B, that refers to B to financial statements. You can see where the B. District-wide financial statements are what we call page 18 and 19. This is where I went back to talk about full pool-based financial statements. This is similar to the not-for-profit or for-profit entities. This is where all your assets and liabilities are books and records. It's on a pool-based amount. The next set of financial statements in your financial statements, it seems like a lot of sets of financials in your financials, is your fund financial statements. These are actually what the board, historically from a budget status and revenue status, this is really kind of more of those line hand in hand when you're looking at on a month-to-month basis. This is your cash basis, like I said, your checkbook, like each month.
That's what currently, basically it says, fund balances,
Yes, we have seen them in the audit.
The next item is reconciliations, which is unique because your fund financial statement is cash basis, your district-wide financials are full base, so what this does actually show the changes. Certain things, I'll give you a good example, fixed assets. You buy it, you do a lot of work on your buildings, $1 million. On your fund financial statements, that's expense. That's done, gone, so depreciated, no depreciation reported. On your district-wide financials, that's actually capitalized an asset, depreciated from useful life. What happens, it kind of goes in one and then gets recreated back in the other, and that would cause some issues, interesting numbers to change on your fund balance or all your net assets. And these reconciliations don't bridge that gap on a yearly basis.
So that's we so some capital improvements got added. We get added value of the district definition.
Yeah, based on your capitalization,
And then the depreciation
it'll go down. But that's not impacting your fund financial, because that's really a cash basis.
Yeah.
Second, you pay for something.
One, two types of accounting.
Yeah,
Let's
you really got
try
two
to-
sets.
Let's try to reconcile that at some point.
Your next set of financials within your set of financials is fiduciary fund financials. This is actually where you're holding in like trust. This is a good example of your ECA activity. But this is basically, ECA activity is, you know, part of this fund, but it's really not part of the school district. But you report it in this fund, which is fiduciary, meaning you have a fiduciary responsibility and board to oversee it. But technically, it's not the normal operation of the school. The ECA is independent of the school district finances. And that actually shows up, and if you look at those financial statements, it's pretty straightforward. Really all it is asset liability, because you don't account for the profit and loss of their activity, it's just to cover any debt balance. Your notes to your financial statements, just like a big public corporation, have quite a few pages of notes that explain a lot of things here. Pages 26 through 50. Quite a bit of stuff in there. So, but a lot of it's verbiage discusses the district-wide financials. That being fund financials, I think probably 10 pages of it are just informational, definitional stuff. Supplementary schedules that are built in there. There's things that we call RSI, required supplementary information, which is required by the accounting standards. There's things called other information, or other supplementary information. That's usually things required by New York State regulations. So because RSI is actually part of the accounting standards, it's technically audited by us and reported, kind of. The New York State stuff, because it's New York State, and they don't really have accounting standards, it's in there, and we review it to make sure it's consistent with the information presented, but it's technically not audited by us. Doesn't mean we don't do anything on it. We're required to do something because it's within the financials, but that helps, change the level of responsibility, because the problem is, New York State says we do something, it's not generally accepted across, you go to Pennsylvania, they don't do it, so it's not comparability. Highlights, generally speaking, this is off what we call entity-wide financials. You saw this look like it basically broke even. Jim said that, you're changing that position, and there was a change in that terminology. It's called change in net assets, the new standard. You basically broke even from an entity-wide financials, where you actually have all your assets and liabilities in your books, and you basically got an income before profit about $10,000. So you kind of have expenses about 28.9, and revenue
similar to a balance sheet, it's working the numbers to make it, because you can't.
This includes depreciation that you don't budget for, this includes the gas 45 expense, which is there. Ultimately, the pension expense, where this liability is going to be, it's gonna really reduce, and it falls into this your net assets, that position quickly once you have to report that liability. That expense recognized.
This is prepared by management, you just review it.
Theoretically, your basic financial statement, when you walk in the door, you can't to the, go
All
on.
you can do.
Same pages I own, page 1 through 3, the audit. That's it. Everything else is
Everything else is.
So these kind of balance out, and, you know, sort of specifically, I think we hired a lot of teachers more than we could really afford to pay for. That number would, we'd have more.
Good loss. You would expense more than revenue.
So it's kind of good in the sense of balance out.
You also gotta be cautious that, now you go back to budgetary accounting. Remember by law, we always approve the number. The only way you can exceed that is from board approval, so you gotta be cautious of, if you have a loss on the entity-wide basis, it happens. A lot of this is not cash stuff causing this stuff. But if you spend more on your funds, above your budgetary appropriation, that's a problem. And hopefully, based on the budget status reports, you would have already known that well in advance, so that you as a board could say, look, we have something going on, OC service is way higher this year. You should have done this by end of April. You don't want to find this out now.
Right.
That's what the monitoring of the budget status reports revenue, because you're gonna know, based on budgetary, where you're at. And you need to make some hard decisions, either last quarter, or to start, even the state comptroller said that you start really looking out in the future, starting in January. Like the January timeframe, you really start projecting out where you're gonna land. Unless you have very accurate numbers, trial balance, or general ledger, it's something difficult to project out.
Also, because we have once or twice a year versus monthly recurring.
Yeah. That's why it's so critical, because of appropriation. It's important to really scrutinize. Hey, we need to close, because those numbers are based on quarterly numbers, and you have lines based on each ST3 line, that's the approved numbers. And if you see get close to it, you spent 98% of the balance already in December, and good or bad. Might not good, but maybe it's because it's front-loaded expenses.
As I pointed out at the last meeting, this week right now, because we now have budget status report. We have spent 2/3 of the budget for legal services in 2 months. Unless you count the adjustment, you would always get half of 2 months.
That means that we have to watch that. Where is the money coming from?
Then you gotta, see, that's what, you might
That's
say,
what the
look, we
budget
have
status
legal
report
expenses we gotta
is.
deal with. And we gotta figure out a plan where we're gonna get it from somewhere else. It might be a program, that's what makes it difficult. That's why you gotta know that earlier, than wait what already happens. Some of the things that hindsight's 20/20, once it happens, it already happens. So you've gotta be proactive about it, knowing that numbers are planned, because sometimes you can say, look, we're gonna have to tighten our reins a little bit, maybe not spend so much money on this or that. You can say in certain areas, you can look at, say, 10 here, 20 here, 30 there. Cut back certain things that, you can say you want to cut back a program. There's some other areas that may be a little softer. See, that's what's so critical about the status report. Or the question, and that the manager should be coming to you with that know-how. I wouldn't expect the board to sit there and say, I look at a full report, and question stuff, yes, but not to sit there and know the issues, but Jim or Jim and Janice, where they're gonna end up, they'll tell you that, hey guys.
I go down mine on a monthly basis, like business, just circle where am I over?
Yeah.
What's going on?
Because you
Something's gotta
understand,
get-
is it
something's gotta get-
one-time big transaction, and think that we're gonna be okay, let it walk for the rest of the year, or now we gotta say, man, this seems, costing us 5% a year, we budgeted for 5%, now it's gonna be at 10%. The area that always keep caution, care, help them, need to go, just, get into that budget quickly. We just gotta be very cautious. Teacher salaries are pretty fixed. You've got a lot of things that are fairly fixed, based on contract throughout the years, you don't expect that to change from the budget. That is usually the question, the budget process. time of year.
Yeah.
Let's think about fall, and, we gotta, you might spend a lot more money. There's
Fuel.
a nice, fuel cost.
You have no control over it,
Yeah.
so.
So you got that kind of, layer of what you got to look at in the budget status report. And that should be given to you on a monthly basis in that level. On the next page is actually some of our comments. Actually, in your handouts too is a very high-level summary. It's the left-hand side behind the presentation. Paul, you might
I remember that one.
maybe Michael too, or Dave, a little small.
Oh, yeah.
I actually span it out, put the words on it. It's nothing, it's right there. I printed, took numbers
Right,
out.
makes it stand.
This was asked, this is not something we normally do for boards or committees. This was asked, I think Lynette asked me to do this, and we've been rolling this thing for it. Just a summary of every comment at a very high level that talks to you about, kind of title, expected completion, based on original management intentions when they're completed, who was responsible, secondary responsible, and where we're at. You can see I highlighted certain things in green. We'll change the budget monitoring one based on the conversation Glenn had. Because clearly, you're not comfortable with working right now, comfortable saying that.
We've got one, but we haven't done a pattern yet to show that.
Show consistency.
Hey, man, when I was managing, I was known to actually call them for a little month, but I want to know if things were, so that I would be able to present to the board of trustees that I had it under control. And I've had that for 3 years. This guy's flying in the dark, and I managed it, and true.
Right, you're definitely into trees, also on the
Yeah.
ground. And I agree with you there. So, when I say somebody's agreed, it doesn't necessarily mean that they're not gonna come back and talk,
They can change.
they can change. This is at one point in time that they either developed new procedures or somebody addressed something that we're okay with for now, but things change. Sometimes things that, were okay before, somebody doesn't do some work at year end or something and it becomes a problem again. And, we did this summary for you, which kind of talks you through the material weakness and internal controls. As you can see, there was, material weakness and internal controls in the previous year. I kind of labeled them far left, little MWs. I actually added it this year, so Paul, you recall, that wasn't on there before.
Yep. It is new.
It is new. I just added that column just to, because I really had to go back and say what level of stuff. As you know, material weaknesses are something that, from my standpoint, is could cause a major number being wrong in your fan. At any given time, maybe even the appropriation report that they give you, this would be inaccurate based on the control of the weak not for management to prevent or protect some material. Okay? And that's why, so when I say material, that's material in my eyes. Maybe not the board. Maybe you say, Mike, it's great that you guys look at $400,000, but to me, I want management looking at smaller stuff. I want to know, and usually management, a good example is representation. We ask them to represent stuff to us at a lower materiality because we have to make sure we build in what we call protection risk. So they actually represent us at a lower level than we actually do for overall materiality. Material weaknesses, sometimes people think they're awful and, hate to say, when public companies first had material control done, every single one had multiple, even big public companies that have their investments in them. They're well-run companies. What happened was just the scrutiny and change in the approach of looking at individual controls that caused that flip. Certain public companies still do. What's funny enough is it never really impacted the users of those financials. He said, what they basically said is, hey, you still have clean audit, right? That's all I care about. Hey, you might not run your operation as well. Ultimately, we get the right answer. But on a day-to-day basis, you have something that materially could be wrong. At the end of the day, you presented financials that are free from material misstatement. Therefore, a good example is like bond ratings and things like that. Nobody looks at the internal control letter other than for internal management. It doesn't ever track bond ratings. I've never seen it, because they never question it. You guys have been through it. I've never seen public companies for profit. It just doesn't happen. But it's still important enough to say, why do we have material weakness and controls? Because